So the recession is heating up and bankruptcy is on the table for a fair amount of companies. I'm going to go over 8 companies. I think you should watch out for bankruptcy in 2023 and maybe a bonus one at the end or something. Number 1, Party City, that place you go to for Halloween costumes, decorating, balloons, all of it. Their problem is inflation has hit them pretty hard and no one wants to spend money on, decorating their costumes and whatnot. Party City stock is down more than 90% year to date. So in 1 year, you're down 90%. That's pretty crazy. Tesla's only down 60. And just in the third quarter of 2022, they had $1.8 billion in debt. And now they have restructuring advisors trying to figure out how they can keep things moving, but it does not look very good for them. Interestingly, the creditors of the company's metallic balloon business have been hired as counsel due to the global helium shortage. So there's a little bit of helium shortage is what is hurting Party City. Not really, that's not their big issue. Their big issue is people just don't want to buy their crap. Their possibility of they have a possibility of first quarter bankruptcy filing for 2023. I mean, look at their net income. They were down nearly $400 million in Q3 of 2022, and that's just not gonna get you very far. I mean, the last 3 years it looks like they've just lost money every single quarter. So the one that's hot right now is Bed Bath & Beyond. And Motley Fool noted that the management was just $135 million in cash. And this is a global business that once was valued at $17 billion. So they're going to have to move cash around to possibly stay open, but it's not looking very good. People are noting at these stores that the shelves are bare. And there's a couple reasons. So 1, 40% of their shelves were bare. And that's because suppliers haven't been getting paid allegedly, so the suppliers aren't wanting to ship them new products, so they have nothing to sell. And if you're a company that only sells brick and mortar stores, that's not a recipe for long-term growth. So one news place is calling Bed Bath & Beyond a place that college students exclusively use. So they are predicting they won't survive the educational cliff, meaning that enrollment's going to be down a lot and no one's going to be back to Bed Bath & Beyond to buy their crap. In 2013, the company was valued at $17 billion, and that was the peak evaluation of Bed Bath & Beyond. And up until that point, they hadn't taken on any debt, which is pretty impressive for a company. But it seems like they were a little bit too late to moving to online, and they took $1.5 billion in debt. And now they have to figure out how to pay that back or restructure debt in order to, just stay alive. But it looks like there's going to be a high chance of Chapter 11 bankruptcy coming their way. And on top of that, the stock is completely memeing right now. Number 3, Joanne Fabrics, having some interesting news. The Seeking Alpha reports that Joanne is facing declining sales, comps, margins, and increasing costs are all creating a huge battle that they are very much losing right now. So they're reporting that the third quarter sales were $562 million, but that was down 8% from the quarter before. And 8% from quarter to quarter is a pretty significant drop considering they were going into the holiday season. So to improve liquidity in the balance sheet, the company said it was going to suspend its quarterly dividend, which is crazy considering that many investors were only holding on to Joanne because of the dividend it was paying every single quarter. And if they aren't paying that dividend, there's no reason to hold on to it, which has made the stock plummet. So they have a high possibility of filing also for Chapter 11 bankruptcy in 2023. The next up is the AMC. So is bankruptcy still on the table for AMC? Well, according to Investors Place, rumors persist that the first and second lien holders are working to restructuring their debt and whatnot. I mean, they just had an offering because their stock went meme crazy, and now they have a little bit more money on hand to play with. Personally, I do like going to AMC, but allegations against FTX and Sam Bankman-Fried has said that they have manipulated the stock, but that's not the biggest problem. The biggest problem is they don't have enough money. They're issuing a co-branded Visa credit card to hopefully boost some revenue. I think that's kind of a lame effort at things. I don't know who wants an AMC gift card or a credit card. So basically, since people aren't going to see movies like pre-COVID, it comes to how long can they last, or can they change something in the business structure in order to keep alive? Because they might be surviving right now, but as an investment, it's hard to really have anyone put money behind something that's going to be declining every single quarter. Next up, you might have seen it if you're in a local town. This chain has been going crazy. Dollar General has been putting out stores left and right, and now they're kind of in a little bit of a crunch because of it. See, Dollar General has kind of been going on this restructuring of their brand, kind of trying to target more middle to high income shoppers, because they had been known as just, the cheap guys where you just go to get, your little knickknacks or like your gift bag before you go to a party. So now they're trying to restructure that and become more of a store for everyone. So it's been reported that Dollar General was the fastest growing franchise in America, or chain in America, whatnot. And just like Bed Bath & Beyond, the retailers have been closing stores, but for a little bit different of reasons. See, there's been a lot of labor shortages, and the Dollar Generals have been in these really remote areas sometimes. So they haven't been able to get employees to get to the stores even. So I've seen stores that are closing on just random days because they can't find workers to keep the store open. So in my opinion, it's more of a business move right now and not a panic move, but it definitely doesn't help the bottom line. So coming in at number 6 is Mattress Firm, the company that you see everywhere, tons of different stores. And in 2018, they filed for Chapter 11 bankruptcy to reduce their overall financial footprint. And it worked at the time, but now they're starting to come under new stressors. See, according to Bloomberg, the demand for their bedding products has been declining as consumers cut spending with the harder times in the recessionary inflation that has been hitting us very hard. It is weird to think that people are not sleeping anymore. No, that's not the case. They're just not replacing their beds as quickly. Bloomberg reported that one of their main bedding manufacturers is filing for bankruptcy in January 2023, so that is not going to help Mattress Firm. In October of 2022, Retail Dive listed Steinhoff as having a 4 to 9% chance of filing for bankruptcy. Keep that in mind. So Mattress Firm might not file for bankruptcy. They might, who knows, but it is seem like the financial times right now is hurting. The next up, The Gap. The Gap, according to Retail Dive, third quarter sales rose by 2.4%. That's a good thing. But with Banana Republic leading the way with an increase of 8% net sales in the sector. If we remember the CPI report, for whatever reason, apparel was up last month, and I don't know why. But so despite good sales figures at the last quarterly report, it is something important to note that during a recession that consumers are going to cut spending from categories that aren't essential. So apparel, accessories, phones, stuff like that, stuff that is not essential for life. So you could see apparel companies take a pretty big hit during a recession. And last up, a company that has been surviving much longer than I anticipated, one of the mall anchors, Kohls. Sears did not hold up as well as Kohls has. According to New York Times, retail sales in November were down by a little bit, 0.5%. But also you got to remember, this is leading up into the holiday season where retail sales should be higher than normal. So the sign that they're down isn't necessarily a good thing. Insider reported that sales have slowed from the October of the year before. So not a good sign. The thin margin inflation and the decline in discretionary spending does not look good for the company, and it is squeezing them financially. So this could lead to a bankruptcy. Not that they're in a bankruptcy, but it could lead to one. Who knows? I'm just speculating. All these are speculations, and I am not an advisor, but you can get my 2 cents.